Hello folks, Charlie Gipple here. Hey, I want to start out this video by thanking you for your feedback, your email, your texts, your likes from the video that I posted on Saturday morning. Let's see, it's Thursday morning, so 5 days later, and we already have around 3,000 views on LinkedIn. Actually, probably by now we have over 3,000 views. So I want to thank you for that. Thank you for your feedback. Needless to say, I'm going to continue to do these because it does seem like it was somewhat of a success. So I'm going to do these on a weekly basis. What I'm going to do these videos on, I don't know. You know, whatever I feel like that day. I could talk about behavioral finance like I did on Saturday. I could talk about things near and dear to my heart like annuities and life insurance. I could talk about the economy. I could talk about how interest rates affect annuities and life insurance differently when those interest rates increase, when those interest rates decrease, all that fun stuff. So I could get really geeky with it and technical, or I could stay right brain sales oriented, sales concepts, stuff like that. So that's what I'm going to do on a weekly basis. I'm going to start this week with this. Yes, that's right. If you grew up in the 1980s, you notice this thing on the bottom right hand side of your screen. This is the Nintendo Classic. This is like a unicorn. You cannot find these in stock, except for yesterday, I did find this in stock. This is at Best Buy. I was with my 8-year-old son walking through the aisles. We were doing some shopping, and I came across this sucker. And as soon as I saw it, I snatched it. I grabbed it. Why? Because this is, well, this is growing up in the 1980s. This is Mike Tyson's Punch-Out. This is Double Dragon and like 28 other games that are downloaded on this thing. So I took it up to the cashier with my 8-year-old son, and the cashier says, okay, sir, it's like $70 and some cents, $70 and like 30 cents, which is a pretty darn good deal, by the way. She says, but you can add an additional $2.50 to this thing by purchasing, what do you think that was? Insurance. By purchasing insurance on this. So should this thing break down, you can bring it in, you could have it replaced, no questions asked, $2.50. Now, me being a geeky insurance guy, a lot like some of you guys and gals, I thought to myself, well, first of all, $2.50 on a $70 item, that's pretty darn expensive insurance, right? That's like 3.5%, 3%, 3.5%. That's expensive insurance. But the second thing, which is actually what drove my end decision, was we all know that insurance is usually for the catastrophic, right? Meaning if something were to happen, you should only have insurance on that loss if replacing that loss would be pretty catastrophic, would be hard to do with out-of-pocket expenses, right? Now, although myself, I would be absolutely devastated, and it would be catastrophic to me if I lost this thing, if this thing broke down, because I already love it, my family would probably argue otherwise, right? That is not a catastrophic loss to me and my family. So needless to say, I declined that insurance. Now, I don't know what the probability of loss is for this thing, but to my point, to get to my point, I do know this. Over a year's period of time, there is a 1 in 240 chance that a consumer is going to total their car. National average, granted in Boston or New York, it's probably like a 1 in 2 chance. I love Boston, New York, but traffic is crazy. But nationwide, a 1 in 240 chance over a year's period of time, one is going to total their car. How does that consumer take that risk off their personal balance sheet and give that to somebody else? Through the use of insurance, that magical pooling power that insurance companies have. So you know what? If you pay $100 today on your automobile insurance and you get in a $30,000 crash tomorrow, that insurance company can very well pay for that because of the magical pooling power, right? So we insure our cars. What about our homes? There is a 1 in 1,200 chance, 1 in 1,200 chance that over your lifetime, your house is going to burn down. Fairly catastrophic, right? How do you take that risk off your balance sheet and transfer that to somebody else? Through the magical power of pooling that insurance companies have. Conversely, think of this. There is a 7 in 10 chance, if you are over the age of 65, that you are going to experience a long-term care event. That is, for instance, a private nursing room, $100,000 per year. The Genworth Cost of Care Study, 2017. $100,000 per year is the average cost, maybe it's the median cost actually, of a private room in a nursing home facility. That is catastrophic, but yet less than 15% of the public that should buy long-term care actually purchases long-term care. What about running out of money prior to the end of your retirement? running out of money in retirement. In 1994, there was a gentleman named William Bingen, B-E-N-G-E-N. In 1994, he came out with this rule, a white paper. It's out there online. Just punch in William Bingen withdrawal rates and you'll find it. But he said in 1994 that if you have $1 million at retirement, you should take out no more than 4% of that portfolio, 4% increasing each year for inflation or decreasing for deflation. 4%. So $1 million, you're only taking out $40,000 per year. Fast forward ahead to 5 to 7 years ago, Morningstar came out with a study and said, oh no, you take 4% from your portfolio out, there is a 52% chance of failure. There is a 52% chance per hour. Morningstar's modeling, which is pretty credible modeling, right? There's a 52% chance, a 1 in 2 chance that retirement is not going to last a 30-year period of time, or the money is not going to last a 30-year period of time in retirement. That is a catastrophic risk, right? Running out of money prior to running out of time. Why would a consumer not look at those last two risks, long-term care, longevity risk, and taking those off their personal balance sheet, using that magical pooling power that insurance companies have so that they don't experience those long-term care or longevity risks? I appreciate your time, and again, I'll talk to you next week.